You have watched somebody on YouTube make $1,000 trade in 30 minutes and told yourself you could do it too. 9 out of 10 people who try day trading lose every dollar they put in. Not because they were bad at reading charts, but because nobody told them the one rule that separates the traders who consistently make money from everyone else. This video fixes that. There's one calculation every profitable day trader runs before entering any position. Not during the trade, not after, but before. Most traders who blow up their accounts never run it once. I will show you exactly what it is. But first, you need to understand what day trading is, because most people who blow up their account thought they were doing something completely different. Here's what day trading is. Day trading is betting on which direction a stock will move in a single day. You get in, you wait for the move, and you are out before the market closes. You are not buying a company because you believe in it. You are not holding anything overnight. You are reading a chart and asking one question: is this price going up or down in the next 30 minutes? That is the whole game. This changes everything about what information is useful. If you are a long-term investor, knowing the business matters, who runs it, what it earns, whether its market is growing, all of that is relevant when you plan to hold a position for months or years. A day trader does not care about any of it. The business behind the stock is irrelevant to where the price is heading in the next hour. What matters is whether the price is moving, whether that movement has real conviction behind it, and whether the trade is worth the risk. Here is what that looks like. A stock opens at $48. By 9:50, it has shot up to 52 on volume 3 times higher than normal. The company makes computer chips and just reported strong earnings. You do not care. What you care about is that the stock just broke through a price it failed to break 4 separate times over the previous 2 weeks. The sellers who kept defending that price are gone. Buyers are in control right now. That is the setup. The earnings report is noise. The key point is this: day trading asks one question and one question only. Where is this price going in the next hour? Walking into day trading with an investor's mindset is the first mistake most people make. But knowing what the game is does not protect you from the next problem, because the next problem is not about strategy. It is about the clock. The market opens at 9:30 in the morning and closes at 4 in the afternoon, 6.5 hours. But the moves worth trading are concentrated into 2 windows. The first is the opening 90 minutes, 9:30 to 11. Overnight news has already repriced everything before the bell. The people who move markets are active at full speed. This is when the biggest price swings of the day happen. The second window is the last 30 minutes before close, 3:30 to 4, when traders close out their positions for the day and the market makes one final committed push before the close. Between 11 in the morning and 2:30 in the afternoon, volume dries up. Stocks drift and bounce with no direction. A move at noon looks identical to a move at 9:50 on a chart. It is not the same. At 9:50, real conviction is behind it. At noon, most of the money that moves markets is gone, and what remains is mostly noise bouncing between the same 2 prices. The first thing profitable traders learn is not which hours to trade. It is which hours to stay out. Most of the damage in a losing week does not happen at 9:30. It happens between 11 and 2:30, where there is no real conviction behind any move, but you are still sitting there staring at a screen with a live account. Sitting at your desk all day, forcing trades through that dead window, is how a clean morning turns into a flat day. The real opportunity is in 2 windows. Trade inside them and nowhere else. But knowing when to trade is only half of it. The other half is understanding what you are looking at when you open a chart, because most of what a new trader reads as a signal is just noise. Day traders track price levels, specific prices where buyers and sellers have clashed repeatedly. When a stock keeps hitting the same price and getting rejected, that price is called resistance. Sellers keep showing up and stopping it cold. When a stock keeps bouncing off the same price from below, that is called support. Buyers keep showing up and holding it there. The same people return to those levels every single time the stock comes back. This matters because these levels are where the most readable trades form. When a stock hits a resistance level, one of 2 things happens. Either sellers defend it again and the price falls back, or buyers finally push through. The sellers who bet on a rejection get caught on the wrong side and the price accelerates fast. You can see both of those coming if you have been watching the level build over days. A level tested 4 times and held carries real weight. When it finally breaks, the move behind it is not random. Picture this: a stock bounces between $45 and $50 for 3 weeks. It hits 54 times and falls back each time. On the 5th try, it closes above 50 on twice the normal volume. The sellers defending that level are now stuck in losing trades, and every one of them needs to exit. That forced buying adds pressure on top of whoever just broke through. Former resistance becomes support. The move is above 50 from here, not below. That is not a prediction. That is what mechanically happens when a contested level breaks under real buying pressure. The key point is this: price levels are not random lines on a chart. They are the places where the same fight keeps happening. And when one side finally wins a fight they have lost multiple times before, the move is real. But knowing where to look still does not make you money, because here is the actual reason 9 out of 10 people lose. It is not that they cannot find trades. It is the math behind the trades they take. This is the calculation I mentioned at the start. Before you enter any trade, two numbers have to be locked in. How much you lose if it goes against you, and how much you make if it goes your way. The ratio between those two numbers is the only thing that determines whether your whole approach works over time, not your win rate. The ratio. Here is why. If you are risking $1 to make 2, that is a 2-to-1 ratio. With a 2-to-1 ratio, you only need to be right 45% of the time to grow your account. Here is the math. 45 wins at $2 each is $90. 55 losses at $1 each is $55. You come out $35 ahead while losing on more than half of every trade you take. Now apply that same 45% win rate to a 1-to-1 ratio. You break even before fees, which means you actually lose once the platform takes its cut. Drop the ratio below 1-to-1, and it does not matter how good you are at reading charts. Over enough trades, you lose every time. Here is what this looks like on an actual trade. Stock is at 48. You think it is going to 52. A $4 gain if you are right. You decide that if it drops to 46, you are wrong, and you exit immediately. $2 risk. 4 divided by 2 is 2-to-1. With that ratio, you only need to win 45 out of every 100 trades to grow your account. 9 out of 10 traders who blow up are not blowing up because they cannot read a chart. They are taking trades where they stand to lose more than they stand to make. And over enough trades that math destroys every account it touches. The key point is this. You do not need to win more often than you lose. You need the ratio right before you enter. 2-to-1 minimum. If the trade does not offer that, do not take it. Understanding the ratio is half of it. The other half is enforcing it when the trade starts going wrong. And every part of your brain is telling you to give it 1 more minute. A stop loss is a price you set before the trade. If the stock hits it, you close out and take the loss. If you buy at 48 and your stop is at 46, you exit when it hits 46. Not when you feel ready, but when it hits the number you set before emotions were involved. This matters because the number one reason accounts blow up is not bad trade selection. It is not being able to close a losing trade when it is going against you. $3 becomes $6, becomes a position held overnight while you tell yourself it will come back. The brain calls that patience. It is not patience. It is how a manageable loss becomes one that wipes out everything you made that week. Here is what it looks like. You get in at 50, stop at 47, the stock drops to 48, then 47.50. You move the stop down to 44 because you are not ready to take the loss. It hits 44, you tell yourself it will bounce, it goes to 39. You get out at 38 with a $10 loss on a trade that should have closed at 3. You did not get unlucky. You move the stop. That is the whole story. A stop loss does not stop you from losing. It stops a loss from becoming the kind that ends your week. Now, here's the trap that still catches traders who understand everything above. Profitable day traders make 2 to 5 trades in a session and stop. Most losing traders make 15 to 20. Once the first 90 minutes are over and the clear setups are gone, the market is still open. So they stay. They force entries where there is no real level, no real volume, just price drifting in a way that looks like a setup if you stare at it long enough. Small loss, small loss, small loss. The morning is gone. The market being open is not a reason to be in it. Some of the best sessions end before 11. Log the results and walk away. The same market opens tomorrow. 3 mistakes that still wreck traders who know all of this. First, trading on news. The moment you read a headline and want to buy, somebody already bought it 30 seconds ago and is looking for someone to sell to. That someone is you. Second, entering without a defined exit. Every trade needs 3 things locked in before you open it. Entry, price, profit, target, and the price where you are wrong and out. Missing any of those 3 means you are not trading with a ratio. You are guessing with a live position, and guesses do not have a ratio. Third, adding to a losing trade. Your stock drops to 47 instead of going to 52. Instead of taking the loss, you buy more at 47 to lower your average. Now you have twice as much money in a trade that has already told you it is going the wrong way. This is not a recovery move. It is the fastest way to turn a $3 problem into one that ends your week. And it is the first thing losing traders reach for when a position starts going bad. Here is what you now know. Day trading is about where price is going today, not what the company is worth. The real moves happen in 2 windows, the first 90 minutes and the last 30 minutes. Price levels are where the clearest trades form. The ratio between what you risk and what you make is the only thing that determines whether any approach works over time. 2-to-1 minimum, every trade, no exceptions. A stop loss is what makes that ratio mean something the moment a trade starts going against you. You do not need to win more often than you lose. You need $2 of potential gain for every $1 at risk before you open the position. Before your next trade, 3 numbers: entry, price, profit target, and the price where you are wrong and out. Divide the potential gain by the risk. If the answer is below 2, point, close the chart, and wait for the right setup. Every trader who has made consistent money in this market runs that check before every single position they take.